Good morning, Venture Capital. This is Metagame, and today's episode is about the fierce competition among quantum startups vying to fundamentally transform the fabric of our technological reality. Private equity is about to eat venture capital's lunch, and most VCs don't even see it coming. Here's what I mean. While you've been tracking mega rounds in foundation models and celebrating another AI infrastructure deal, something far more consequential happened in March. Reuters dropped a story that should have sent shockwaves through Sand Hill Road. OpenAI, the company that's absorbed more venture dollars than some small nation's GDP, is in advanced talks with TPG, Advent, Bain Capital, and Brookfield. Not for an investment round, for a joint venture, a distribution engine designed to roll out enterprise AI products across PE portfolio companies. Let that sink in. The most valuable AI company on the planet looked at the enterprise deployment problem and said, "You know who can actually solve this? The people who already own the enterprises." This is the moment the game changed, and if you're not paying attention, you're already behind. Let me paint the picture. TPG alone manages roughly $229 billion in assets across dozens of portfolio companies. Brookfield, over $900 billion. When you aggregate the PE titans in this reported deal, you're looking at operational control over thousands of companies with collective IT budgets in the tens of billions. That's not a customer list. That's a distribution channel. PE firms have spent decades perfecting the playbook of centralizing procurement, standardizing shared services, and driving operational efficiency across their holdings. Now they're looking at AI deployment and saying, "We've done this before. We know how to roll out transformational technology at portfolio scale." And here's where it gets uncomfortable for VCs. You've been funding the supply side of the AI revolution, the models, the infrastructure, the developer tooling. That $202 billion in global AI funding over the past 18 months, overwhelmingly concentrated in R&D and capability building. But the actual bottleneck, the place where all that innovation gets monetized, is enterprise deployment. And PE just made a very explicit move to own that layer. Think about what this means structurally. Venture captures innovation economics. PE captures implementation economics. You're funding the research lab. They're building the distribution machine. And in enterprise software, distribution has always been where the real money lives. The data supports this thesis from multiple angles. On April 1st, KKR led a $90 million Series C into Coder, a company focused on secure enterprise AI development infrastructure. This isn't KKR betting on which foundation model wins. This is PE funding the picks and shovels layer that every enterprise will need, regardless of model choice. Secure dev environments, governance tooling, integration platforms, the enabling infrastructure for portfolio-wide AI rollout. KKR isn't playing Venture's game. They're building the toolkit they'll need to execute their own distribution strategy. Meanwhile, the Federal Reserve's April Beige Book data collected through April 6th delivered something remarkable. For the first time, the Fed explicitly acknowledged that AI-driven productivity improvements are affecting business operations. Several districts reported firms using AI gains to delay or reduce hiring. This matters because it moves AI adoption from vendor PowerPoint claim territory into Fed-observed economic behavior territory. Adoption's happening. It's showing up in operating plans. The question isn't whether enterprises will deploy AI at scale, it's who captures the economics of that deployment. But here's the friction point. The same Beige Book flagged rising technology costs for hardware and software, and the March CPI print, released April 10th, showed inflation re-accelerating, up 0.9% month over month, 3.3% year over year. Energy drove a lot of that, but the implication for enterprise IT is clear. CFOs are scrutinizing budgets harder. Approval cycles are extending. CIOs are demanding proven ROI and referenceable deployments, not just promising demos. This is exactly the environment where PE's value proposition shines. When a CFO is nervous about AI spend, would they rather trust a venture-backed startup pitching one-off deals, or a PE-backed implementation engine that's already deployed the same solution across 50 similar companies? The answer is obvious. PE is positioning itself as the de-risking layer for enterprise AI adoption. KPMG's Q1 2026 Venture Pulse confirms the structural shift. Funding is concentrating into fewer, larger rounds. Mega deals dominate headlines, while early-stage volumes show weakness. Investors are demanding measurable ROI in unit economics, not just growth at any cost. This bifurcation maps perfectly onto the PE distribution story. Venture funds the concentrated innovation bets. PE organizes the demand side and captures deployment economics at scale. So what does this mean for your portfolio? First question, are your enterprise AI companies built for PE distribution channels? If PE firms become the primary path to enterprise deployment, your portfolio companies need to be PE friendly. That means they can scale through standardized rollout programs across portfolio companies, not bespoke one-off implementations. Horizontal platforms beat vertical point solutions in this model. Companies with strong services arms or low-touch deployment mechanics beat pure software plays that require heavy customization. Second question, who captures the implementation economics? Historically, enterprise software vendors kept both product revenue and professional services margins. If PE firms are organizing implementation at scale, they may demand a larger share of services, economics, or push for deployment models that minimize vendor involvement. Your portfolio companies need defensible pricing power and measurable ROI data, not just feature velocity. Trust me, this will improve productivity. Pitch collapses when you're negotiating with a PE firm rolling out across 100 companies who can benchmark your claims against actual results. Third question, what happens to standalone enterprise AI vendors without distribution partnerships? They risk becoming orphaned. Great technology, no scalable go-to-market. This could accelerate M&A with PE firms or enterprise software incumbents acquiring promising vendors to fold into standardized deployment programs. That's an exit pathway, sure, but it's also valuation compression if you don't have defensible distribution. The opportunity here is real, though. Back the infrastructure plays PE needs to execute their strategy. Secure development environments, governance and compliance tooling, integration platforms, observability, and monitoring for AI systems. These are the enabling layers that benefit regardless of which application or foundation model wins. The risk is commoditization. Infrastructure often has lower margins than apps, but the distribution access and customer concentration from PE portfolios can offset that. Let me break this down simply. The enterprise AI value chain is splitting. At the top, you have foundation models and infrastructure. That's where venture dollars flow. In the middle, you have application vendors trying to sell into enterprises. At the bottom, you have implementation and deployment, and the actual work of making AI operational inside organizations. PE just announced they're building a toll road across that bottom layer. Every enterprise AI vendor that wants to reach customers at scale may have to drive through PE's distribution engine. The VCs who win in this environment are the ones who recognize the game has changed. You're not just competing for the best AI companies anymore. You're competing for companies that can plug into PE-orchestrated rollout programs. Companies that can win a deploy across 50 portfolio companies. RFP, not just impress a single CIO in a proof of concept. Still think PE is just a late-stage capital source? Still treating them as the people who buy your winners after you've done the hard work? While you were building the AI supply chain, they were positioning to own the demand channel. OpenAI saw it. TPG, Advent, Bain, and Brookfield saw it. The question is whether you see it in time to adjust. Private equity isn't just writing checks to AI companies anymore. They're becoming the enterprise AI distribution engine. And if your portfolio companies can't sell through that channel, you might be funding brilliant technology that never finds its market. The last mile of enterprise AI isn't a technology problem. It's a distribution problem. And PE just raised their hand to solve it at scale. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.